Hello, good afternoon, everyone, and welcome to Insignio's weekly speaker series. I'm happy to be joined today by David Albrycht from Newfleet, the CIO. David, how are you today?
I'm good. Thanks for having me.
Great. Yeah, great to see you again. So, David, you are obviously the president and CIO of Newfleet. You focused on fixed income. We've spoken about fixed income with you in the past. So let's start right there. Give us your 30,000-foot view about the fixed income space in the United States specifically. Let's talk about rates. Let's talk about the Fed. Give us your macro view.
Yeah, I would say, first and foremost, I think the thing that people are most concerned about is the magnitude and the timing of any type of slowdown. That's something we're watching very, very closely. Our feeling is that they can orchestrate a soft landing, a mild recession for a few reasons. I'd say first and foremost, the consumer is in decent shape. 6 months ago, mortgage, credit card, and auto loans defaults peaked. Obviously it's trending upward. In good shape from stimulus program, a lot of cash on hand, so starting from a good point. Corporate balance sheets were in great shape. If I look at high yield defaults, right now are about 2.25 on an issuer basis. Average is about 4.1, so they're starting from a good point. They've extended debt maturities, leverage is down, interest coverage is solid, and then I'd throw out access to capital has been fantastic. Whether you're in leverage finance, whether you're in IG, where they've issued 155 billion, structured product, even seeing some of the subordinated tranches massively oversubscribed. So some very good liquidity. I would think some of the other concerns that I would throw out there: student loan debt coming due. That's probably 2 to 3/10% of GDP. I would definitely think about energy here. I'm looking at WTI and Brent. We're back up around 93, actually 94 as we speak. That could be a concern. And then last but not least, we have the United Auto Workers tonight. They'll make their decision if they're going to go into a strike. And, hopefully that will be short-lived, but we'll have to watch that very closely. Oh, and one thing I can't forget about, of course, is the debacle that we saw back with Silicon Valley Bank, First Republic, the banking crisis. The agencies obviously reactive. We saw Moody's, S&P, Fitch all be reactive to the problem, but we'll watch that very closely. We actually took it as an opportunity. We went out and bought the better capitalized regionals with lower CMBS exposure, like a Huntington, a Fifth Third Bank Corp, Citizens Bank, which we thought all made sense at the time. But we think the market's in good shape. We're defensively postured in sector. I think we have plenty of fuel for the fire if anything changes, and we've done well year to date and also on a 1 year basis.
Right. So you've mentioned some of the concerns and some of the things you're looking at. I didn't hear you mention possibility of a government shutdown. That's looking also very likely right now, but obviously that can change. Are you concerned at all about that?
Of course, we'll watch that closely. We always hear that threat usually goes down to the wire, and then they usually either somehow manage to wiggle their way out of it. So something we're watching. It's definitely a consideration without question. You did ask about a few things that I forgot to address. You asked about the Fed, who has raised rates 11 times, 525 basis points. I think they made it perfectly clear they want to be data dependent, and more importantly, they're going to continue to fight inflation. The next meeting is September. We're under the belief that they're going to pass in that meeting. And then they'll have plenty of data to absorb by the November and December meetings. So we'll see what happens then. Maybe another 25, but I'd say near the end of the cycle. And if I really look at, rates, you've had a huge move in rates. Rates have moved dramatically. The curve has been inverted now, March, but then it was uninverted. So maybe June. So 15 months, typically 12 to 18 months into a inversion is a recession. Not the reason for it, but the possibility of. And right now, I think Bloomberg just came out and said that we've eclipsed the longest since 1962 as far as being inverted. So I think, longer, higher for longer on the rate side. We did have some good news in the Fed. If you look at the inflation number, it's down from 9 to 3, which is good. If you look at, things that I would consider, energy, even though we're off, we're higher than we had anticipated. We're off the invasion of the Ukraine by Russia, which was about 120. We're back to the 93s. And then on the good side, on the bad side, the unemployment number is still very, very strong, and services remain elevated. So a lot of stuff going on out there, a lot of things to consider. But in general, we haven't seen value like this going back to the global financial crisis and fixed income in terms of dollar prices and also yield levels.
Right, right. And I'd like to remind everyone that if you do have questions for David, please put them into the chat or send them to me directly. I'd be more than happy to discuss them with him as soon as we have our little chat here. David, one thing you mentioned, you said that the Fed is data dependent. Yes, they've said that. The question is, what data are they looking at? We both know that if they're focused on CPI, they're looking in the rearview mirror. They're getting old news. What data are you looking at as a fixed income investor? Because a lot of the pushback I get from fixed income allocators at this point is that, yes, yields are attractive, like you mentioned. They're more attractive than they've been in 20 years.
Yep.
But there's that possibility that inflation starts to reaccelerate again, which means they're going to get even that much more attractive. So they still don't want to jump in right now. What is some of the more real-time data that you're looking at right now that gives you the comfort to say that, yeah, we are at near the end of the cycle, or perhaps one more incremental jump, but definitely not the beginning of a new hiking cycle from the Fed?
Yeah, I think the things we have to look out for, and I'm not going to tell you that rates are going to go up one or they're going to do multiple rate increases. One of the things we're going to definitely look for is unemployment. What happens there? We're at 3.8%. That could tick up to 4.5, and I think we're still comfortable. Gets above that, then we get definitely worried. And then, without question, I mean, on the fiscal front, we've been spending a lot of money. We have a lot of debt out there, so something we're also watching very, very cautiously. But we're going to have to wait and see. We have 2 more months of data. The recent PPI and CPI, granted, is rearview mirror, but it's been relatively strong. And year over year, we should start to see a little pickup. Numbers be a little elevated in the inflation front. So 1, maybe 2. More rate increases. And again, it's going to be heavily dependent on the data. But from a dollar cost averaging perspective, and I'm a dollar cost averager, I'm in a market timer. What a great time to be getting into fixed income. When you see dollar prices on corporates, 88 with a 570 handle, you see LevFin high yield at 8.5 with an 89 handle, bank loans at 95 with a 10.25 handle. Those are pretty attractive entry levels.
Yeah, no, absolutely. We were looking at a JP Morgan bond here the other day, 5 years out, almost 6%. Very attractive. Yeah. So right now the market is pricing in, if you look at the Fed funds curve, pricing in roughly 100 basis points of rate cuts going into by the end of 2024. Are you in agreement with that? Is that right? Is that too cheap? Is that too expensive? What's your view on what the forward curve is pricing in for rate cut expectations?
It's a great question. I mean, if I look at the forward curve right now, it's like 3.5, almost 4%, 4 times, like you said. So 425 basis point rate increases. Looks like it's probably going to happen sometime in June. All I can tell you is for the last 2 years, the market's been wrong.
Yeah.
So that's one thing to take into consideration. The market's been, always very, very ahead of the curve and very positively, with a positive view. I think the good news is we get the dot plot coming out, so we'll see what the Fed thinks. That's next Wednesday, I believe, and then from there we can look at what they're anticipating as the rate moves to be. Right now, we think rates higher for longer. Do I think there's going to be 4 rate cuts next year? Unless everything goes south, I think that they're probably going to stay for the next 12 months. They're going to stay where they are.
Yeah. I mean, these are all great points. You mentioned the market's been wrong. Another great trade has been take what the Fed is not telling you, right? Because they surely have been wrong as well, right? So no, but I think that's a very interesting point. Let's talk about some sort of sector allocations, opportunity sets you see out there. You've mentioned a few already, but let's dive into some of the more sort of sectors or credits that you find perhaps more appealing out there. That our advisors should be looking at potentially.
Well, if you want to add duration to a portfolio, I think one thing you do right away is look at investment grade corporates. They're yielding right now 577 as we speak this morning. You had mentioned JP Morgan at 6%. We definitely like the banks. We like the large GSIP banks. A Chase, a JP Morgan, a Morgan Stanley, a Citigroup. Those make sense. I had mentioned we had bought some of the better capitalized regionals when there was the recent trade-off due to Silicon Valley Bank and its asset liability mismatch. But triple Bs are definitely the sweet spot. If you aggregate high yield bank loans and IG corporates, a third of the market is triple Bs. So that's a big chunk of the market. Sure. About 7% are vulnerable to downgrade. And as a multi-sector guy, I'm licking my chops when I start to see a threat of the fallen angels like we saw during the pandemic. We saw Ford, Kraft, Occidental, Kraft Heinz, as I mentioned, Hildebrand, all fall, and pension funds and insurance companies are sellers. I'm definitely a buyer, especially when you get 10 and 30-year bullet structure. So we like IG corporates without question. With leverage finance, high yield, and bank loans, we're definitely up in quality. We like the double Bs. In bank loans, I can get a current coupon based on where SOFR and spreads are of about 8.5% with somebody that doesn't need financing and has more than ample liquidity, which is unbelievable. In the high yield market, if you want a little duration, step out a little out the curve. Again, our bias there is up in quality. You don't get paid to take risk, and you're getting deals done. So papers coming to market. On the loan market, we actually saw two months of positive inflows. People are sitting back and saying fundamentals aren't that bad. The economy's good. They just got two positive, inflows, and then probably, you're going to see rates higher for longer. So what a nice time to collect coupon. So those are probably our top sectors. EM, probably one that we're, avoiding. We still haven't got into EM in a big way. We do like emerging markets, but some of the dollar sovereign stuff that we've done, like a DOMREP, a Pemex, a South Africa, Hungary, a Kexum, haven't really played in the local currency markets there. Taking a hard look at Colombia, Chile, Mexico, and Brazil, which we think all make sense. But again, waiting till maybe the Fed's done, the dollar begins to either stabilize or weaken, and we'll obviously watch flows. But we like the foreign market as a diversifier. We'll start to get in a bigger way as we see the Fed stop raising rates here, and probably the last one that I would say we're avoiding like the plague. Probably about 5 years ago, we started avoiding commercial real estate, really because of the retail exposure. And this year we've had 11,000 retail bankruptcies, and you walk into Nordstrom's and you find your favorite Sherpa, you go home and buy it on the internet. You don't need brick and mortar anymore, and that's definitely a problem. We're seeing people walk away from the Hilton hotels in San Francisco. We're seeing they closed the mall in San Fran. They closed a Class A property building down in Atlanta. The ability to refi and survive until your 2025 is sort of the theme there. We're doing some of the new issues, which are giving you a 7% for a AAA, 6-year, 5-year, in that range. We're doing some of the better capitalized deals where the rating agencies are stepping in and say, we don't want to have this like the global financial crisis where we're after the fact. We're going to make you require more credit enhancement now. So some of those deals look attractive. But again, playing with a degree of caution, they were about 3% as opposed to being 20% 10 years ago and sort of being the Rock of Gibraltar of the portfolio.
So you continue to avoid the CRE space, right, as a potential sort of landmines, right, as a place you don't want to be. Okay.
I want to make sure that I'm in either data centers, industrial warehouses, Class A office property, single asset, single borrower deals. But I want to be very, very cautious because I know it could definitely get a lot cheaper, especially with some of the poorer capitalized regional banks having 20 to 40% of their book in commercial real estate. Okay.
Yeah. So I'm assuming that when you did your regional bank play, you made sure to avoid those names that had heavy exposure on their balance sheets there, right?
Poor capitalization, poor deposit base, and then the 20 to 40% in commercial real estate.
Excellent. Yeah. So let's sort of stick in the real estate space, but let's go over to the residential side. I think one of the surprises this year has certainly been the resiliency and strength of the U.S. housing market. Don't know if you remember, David, but at the beginning of the year, Wall Street consensus, I saw prices down, or projection for prices falling anywhere from 15 to 20%. I think if we're lucky, we might end up flat for the year. We might even be up for the year if we get a little bit more positive information. What's your, you hear the supply side, the fact that people do not want to get out of their single family homes. So there's a dearth of supply out there. But is there something more to the story, to the strength of the residential housing market in the U.S. beyond that?
Yeah, a big underperformer last year, but a great performer this year. Solid credit underwriting, record equity in your home. Yeah, it's a little difficult if you have a 2.5% 30-year and you want to sell it and move to Austin, Texas, and get a 7-year, 30-year conforming. It's a little different. Your house is going to shrink in size. You know that.
Yep, it sounds like you contemplated that move from the Northeast, David, right?
I've had actually my nephews from California telling me like we wanted to move, but we can't. But
that's right.
You got a big equity buildup, which is really good.
Yeah.
More importantly, and I think the key is back in 07, they were building 1 million houses per year. In 09 through today, they're building about 250,000. So over the last 12 years, there's been a shortage of about 700,000 houses per year.
Yep.
So even though rates are elevated, you see rates drop into the 6% range, people are buying houses. Single family rentals, single family houses are definitely in insatiable demand. I agree that you're probably going to see a flat to even a little appreciation this year. And we're getting you're getting about a 6.5% on a $91 price with a AA type credit. That's good for non-agency. For the agency, current coupons 5.5 year, you're probably getting 6.25.
Yeah, I was going to ask you. So, like, how are you playing this on the MBS side potentially, or some other areas? How are you doing this?
I'd say our bias has always been the non-agency market, a little more resilient to refinancing. If you do some of the small business self-employed deals, which are the non-QM deals, those people are just happy to get a mortgage. They don't have any verifiable income, but they're putting down 30 to 40%, which is a good. So that's how we've been playing that, and it's like I said, an underperformer last year, and we've recently been adding some of the new deals to get duration. So it's been a good way to have a mix of agencies, probably a little less than we typically have, and then non-agency market is one that we really like.
Yeah. So one final topic here before we move on about talking about your strategy specifically, and then we'll open it up for Q&A, and then we'll do a hard stop at 4:30. You mentioned that you saw some opportunities or potential opportunities on the M side, but you don't feel comfortable yet taking on some of that risk. Did I hear you correctly? Was that?
I'm sorry. On the M side, I'm sorry, I didn't hear.
Oh, on the EM side.
Sorry. Oh, I'm sorry. Yes.
Yep.
Yeah.
So what markers are you looking out there for? Say, okay, listen, now's a good time, because we are seeing some EM central banks are already outright cutting rates, right? Like the Brazilian central bank has cut rates. Several like other central banks have cut rates. What sort of markers, what flags out there are you monitoring to say, hey, I'm going to go in and take a stab at some of these markets which are attractive, like you mentioned?
Yeah, I'd say first and foremost, we're watching valuations, and that's what we do. Is we watch the politics, we watch the valuations. You're right, DM raised rates ahead of us, and now they're starting to cut. So they're going in the right direction. We're going to see what the Fed does here. If the Fed is on hold or pauses and the dollar begins to stabilize or weaken, then we'll get involved. And also we look at flows. So for local currency, probably our first step in was dollar denominated sovereign, where we saw a lot of issuance early in the year, which was right. When I'd mentioned we own Pemex, which is a sort of a proxy for Mexico. We own some Hungary, Kexum, some of the more core names. They're not taking a lot of risk. Colombia, and then on the local currency side, things that we'll look at are Mex, Colombia, and Brazil, and those again will be driven by what happens here in the U.S. with the Fed, and really if the dollar stabilizes or starts to weaken, and money starts to flow, there we'll definitely get involved.
Right. Okay. So David, let's shift gears here. Let's discuss the two strategies that you manage, the multi-sector short duration bond fund and the multi-sector fund as well. Give us a quick overview. What are sort of the guiding principles, the investment principles of each fund? What's the difference? What should asset allocators kind of think of or keep in mind when they're looking at these two strategies? And also, if you want, give us some key metrics of each fund.
Yeah. So I would say that, first and foremost, everybody wants to add duration in here. There's value along the entire curve. I just told you about some of the securitized asset backs, some commercial real estate to a lesser extent, the non-agency market. All that stuff is very, very short and high quality, where you're getting anywhere from, 6.5 or 5.5, all the way up to about 8% on IG. So we think there's value there. And our short-term fund that, we focus a lot on securitized, but we also have, take risk in LevFin, high yield, IG corporates. Right now, our MSDU, which is our short-term fund, we have a duration of about 2.4, average credit quality of A2, with a yield to worst of almost 660. And you're getting an average dollar price right now in the probably the mid 90s, probably like 94ish. We think that's great value. A good way to participate in the front part of the curve, especially if you believe that the Fed's done and they're on hold for quite some time. Great way to get value in the front part of the curve. And then we have another fund, which is MSIU, which is a little more aggressive with credit. It's a Baa1. It's got a duration of about 4.26 and has a yield to worst of about 735 with a dollar price of 92. So again, if I'm doing a good job and I'm picking credits that are going to mature at par, which hopefully we're going to do a good job at, you have a lot of upside. Not only the yield, not only the discount dollar price, but the total return potential that you have with both products. MSIU is a little more aggressive. If you like short duration, we have the short duration fund that does 35% in below investment grade, 35% in non-dollar. I'm sorry, in foreign, and then we have the intermediate fund, which is 50.
What's the percentage there? Sorry, in non-dollar.
35% in
35%. Okay,
35%.
so up to 35%, or that's more or less the baseline.
Up to 35% in foreign.
Okay,
so you can do 35%, and below investment grade is 35%. So we like both products. We think it's a great time to be across, invested along the curve. MSIU a little more aggressive. It's 65% in below investment grade and 50% in non-US.
Okay. And how long have you been managing each strategy? What's the sort of the track record? Some key metrics to share with the group.
Yeah. So both I've managed the domestic, the 40 Act fund for 30 years. And I found out that in Morningstar, I'm the longest tenured multi-sector manager that is in the United States as we speak right now. I have over 3
Congratulations.
Of intermediate and short. These two funds right now are one has over a 5-year record and one has about a 4.5-year record. So as far as the foreign products, but we've been managing money in this style for 3 decades with a team of 41 people that's located in Hartford, Connecticut, with also boots on the ground in London and New York.
Right. So you mentioned that, you're not into market timing. I agree wholeheartedly with that strategy. You're into dollar cost averaging. Some asset allocators, though, have different views on this. They want to get into it. What do you suggest to them in terms of allocating into this asset class that they were so hurt in last year that some of them are still a bit, trigger shy? Let's say, what's that old saying? Once bitten, twice shy. But which it probably means you're probably ready to go right in, right? Because the likelihood is that much less that it happens. So what do you recommend for people who are looking to allocate that they understand the value of having fixed income and these types of strategies in their portfolios, but they're a little wary of the timing, especially with the uncertainty around the Fed? What do you recommend that they do? What markers should they look at? Give us some strategies for these asset allocators.
First and foremost, you're exactly right. We had the worst bond market since 1949. And I was in a client event and somebody had their hand up. And I said, that's the first comment I met. I'm like, yeah, he said, since 1845, it's the worst bond market. So it was traumatic last year. Twice in my career have I seen corporate bonds down more than 15 with the equity markets down more than 25. And last year was one of those, along with the global financial crisis. So definitely a painful time, but come out of that and look at where dollar prices are, look at where yields are, and great time to be dollar cost averaging. Now, if I have cash in the bank, CDs, money markets are a viable alternative for my money I have in the bank, right? You're getting 19 basis points, 20 basis points, and I can get 5 or 5.5% in a short-term instrument. That makes a great deal of sense. However, you have reinvestment risk. If I'm wrong and the Fed starts cutting rates in 3 months and all of a sudden sectors start coming back to normal, dollar prices go back to par, yields come back, and you've missed a great opportunity set for total return. So I think you haven't seen a better opportunity since the global financial crisis, as far in terms of discounted dollar price, in terms of yields being inflated to what we haven't seen since 2009. And I think what you should be doing is, if you have a fixed income allocation, you're there, keep it. Dollar cost average if you're not there. And if you have money in cash, if it's from a bank account, it's a valuable alternative. It's credible. But I would do both short and intermediate. I wouldn't try to guess, when I should put duration on, when I shouldn't. There's value in the front part of the curve. There's value in the intermediate part of the curve. So I think both have great value.
Right. So I'm also not going to put words in your mouth, but we here at Insignia, we've been telling our FAs that at 4.25, the 10 year is quite attractive. 4.50, we'd be buying it pretty aggressively. We have a view that the Fed's definitely not going to be able to cut rates nowhere near what we've seen the previous two cycles. We thought those were, exogenous shocks. This is much more likely to be a typical run of the mill recession caused by the central bank raising us into one. What's your target for? You mentioned that your base case is, sort of technical mild recession, which sounds pretty much in line with our view here. What levels do you think the 10-year could get to under that scenario?
Yeah, I mean, you're probably your worst case in the 10 years. Trend 10 years somewhere 450, maybe if you're pushing it 460. And we're definitely a buyer at those levels. We think that's a home run level. And as I had said, you saw this year the volatility. We went from 380 to start the year. 2 weeks in, we were at 320. Flight to quality, we're actually the banking crisis. We were up to 420, back to inside of 320. It's been all over the place. So rates have been extremely volatile. One thing I would say is if you start to see 450, 460, we're definitely a better buyer of treasuries. You're not getting hurt by being in treasuries, right? You're getting a very, very comfortable yield for taking little or no risk. Not you're taking interest rate risk, but you're not taking credit risk. Right.
And in case of a mild recession, you think target on the 10-year could be what, two and change, and low three hand? Like, what's your view on where we?
Yeah, I would say that just judging by history, the last 8 recessions, the Fed aggressively cut rates three months after the final rate increase.
Right.
And then you probably could see the 10-year inside of 3% without question.
Yeah. Okay. Excellent, David. So let me share with you a couple of questions that I've gotten here directly. One is on China. We didn't really talk too much about China or the Chinese slowdown, but I'll mention it to you. Are you concerned with the slowing levels in China? Although there have been some green shoots, I would like to point out here in the past couple of days or so. We'll see, and there continues to be piecemeal easing coming from the PBOC. But please, let's hear your thoughts on the Chinese growth story.
Well, for China, if you would have asked me, coming out of the COVID lockdowns, with how would they have done? I would say they've been screaming. It would have been yielded 5 or 6% type growth. Yeah. Slow growth and disappointing data has come out of them. They've cut rates twice, in the last 2 weeks to provide some type of stimulus. The real estate sector is definitely under pressure. Their shadow banking is under pressure. They are a third, of the big three, right? They're one of the big growth, engines of the world. So we need China to do well. So we're watching it very closely. A little disappointed with the growth that we've seen out of there. However, they're going to be a driver of the world economy, and I think you have to watch it very closely.
Yeah. And final question here, because we are running out of time. Let's talk about Europe. We didn't mention it much. How do you see the credit markets over there, the rate markets in Europe?
I think Europe is further ahead of the U.S. I think they did their final rate increase 25 basis points today. I think it's their 10th rate increase. I think they'll go into a recession, a mild recession, maybe a little harder than that. And there's opportunity there. So we're looking at some of the dollar denominated issues, some of the European like British American tobacco that we've looked at recently that makes sense. But we've definitely have it on the radar screen. So
yeah, one sector that's quite popular with our network are the European banks. Any views on European banks?
Yeah, the European banks, I think we found out with Credit Suisse, First Boston, haven't really recovered from the global financial crisis, and you got to watch out for hidden time bombs there. I would just be very cautious with a Deutsche Bank, UBS to a much lesser extent. But again, make sure you're comfortable. I think a lot of things there are off balance sheet and hidden. So I'd be very, very cognizant of the risks with some of the European banks. We do own Santander. We do have exposure, but be cognizant of the risks that are definitely with the European banks.
Great. Well, thank you so much. Well, David, thank you for joining us. So David Albrycht, CIO of New Fleet, portfolio manager of the Virtus Multi-Sector Short Duration Bond Fund and the Virtus Multi-Sector Income Fund, both of which are available on our platform. David, once again, thank you for joining us. Pleasure seeing you. Insignia Financial Group, LLC, comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions.
principally in Latin America. Brokerage products and services are offered through Insignio International Financial Services, LLC, headquartered in Puerto Rico, and through Insignio Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignio Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignio International Asesores de Inversión Uruguay, SA, Insignio Asesores de Inversión Latam, SRL, and Insignio Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignio Argentina, SAU, and in Chile through Insignio Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignio Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignio.com/disclosures/ or via www.finra.org. To learn about Insignio Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.